Hi friends, my name is Sourabh. Welcome to my this online webinar, online tutorial, online training on the topic which is called as options. After my couple of videos in the past, I have received several queries from the people across India and across the globe that they want to know about the basics of options and how they can use or how they can trade into options in the Indian Stock Exchange in the National Security of Exchange NSE. So this particular video, I will try and explain the very basics of options. Apart from this, all the components, all the information that are related to the options, I will try and explain all those things in this particular session. This particular session is mainly targeted for the beginners, for the newcomers who don't know much about the options, and for the intermediate level of people, because there are few things which I will also be saying, which I will also be explaining, which would be little above the basic sections or from the beginners to the intermediate level. So this particular video is basically targeted for the beginners to the intermediate level of category of people who are interested to learn about the options, who are interested to know about the working of the options. Okay, so before I proceed, let me tell you about a little small introduction about myself. As I mentioned, my name is Saurabh. I am founder of a website called as pivottrading.net. I started this website around 8 to 9 years before in 2008. Apart from this, I'm also an algo trader. I do auto trading for my personal use. Apart from this, I'm working on many other strategies for automating those strategies into the Indian stock market. Apart from this, I am basically associated with Zerodha. Zerodha is an online discount brokerage house started up around 5 years before. I'm proud to be associated with Zerodha as one of their Mumbai division partners. Apart from the Mumbai, I am also their online marketing partner. So people across Mumbai, Maharashtra, and across India, from all states of India, contact me for their account opening queries, account opening help, and I provide some added advantages, added benefits to the people who approach me for opening an account in Zerodha. I will explain a little more about this when I come to the end of this particular session. But for now, I would like to say, in case if you are interested, or if you, your friends, any of your relatives, colleagues are interested to open an account in Zerodha, get connected to me through Zerodha. Feel free to approach me. Feel free to call me on this particular number, or feel free to text me or telegram me on this particular number, and I will try to assist you in whatever way I can. Below are my two email addresses. You can contact me on my email addresses as well. And for those who have never visited my website before, you can go on to this particular website, which you can see in the list here on the URL here. The name of my website is www.pivottrading.co.in. There are 95% of the contents of this particular website of my website are completely free. You don't have to pay anything. If you're looking for some free knowledge, some free tools for your intraday trading, feel free to come to my website, and you will find a whole lot of materials for your intraday trading. Okay, so that was all about myself, the business that I do, and what all things I'm associated with. Now let's go a step further. Let's look what are we going to cover in this particular session. What are the topics that we are going to cover today? Okay, so let's begin. So these are the few topics that I'm going to cover in this particular session today. We will start with the derivatives and options. Um, we'll further look into what are the types of options that are available. We will take a further step, and then we will look into what are the components of the building blocks that comprises or that makes up the options. What are the different types of different styles of the options that are there? We will also look into what are the different types of contracts in the options that are available. What is the risk in the options? What are the basic strategies of options? And finally, we will look a practical example in an NSE how you can understand the options, or how you can figure out in NSE what option is and what does it signifies. So that we will look towards the end in a practical example. When to buy and when to sell would be our last section, and which I'm planning not to cover in this particular session. I would create another session or another video where I would specifically be explaining what to buy, when to buy, how to trade into options, or basically trading strategies would be defined, or trading techniques in the options would be defined in that particular video. So this particular video is more of giving you a theoretical as well as a knowledge about what options are and how to understand, how to interpret the options and their prices. Okay, so let's go into uh, derivatives and the options. So let's take a look at what derivatives are. Derivative is a contract between two or more parties whose value is based on an agreed upon underlying financial asset, index, or security. Common underlying instruments include bonds, commodities, currencies, interest rate, market indexes, and stocks. So this is a very generic definition which I told you about the derivatives. In a layman terms, is basically it's some kind of agreement which is done between the two people, two parties, two institutions, two banks, any two individuals who are trading, and this particular contract is about trading, buying or selling any particular financial instruments at any defined future date. So this is a generic definition of derivatives. Now this underlying assets could be anything. It could be your stocks, it could be your currencies, it could be bonds, commodities, few market indexes, stocks, interest rates, anything. It could be anything. S- Now within derivatives, there are multiple things that are included. Derivatives is a very broad term. It just tells you, or it just says that it is some kind of contract where you are buying and selling something on any specified future date, but you are agreeing upon the prices of as of today. That's the only difference between the equities or the normal trading instruments and the derivatives. Derivatives are no physical components or no physical instrument. They are basically derived components. They are derived on some kind of underlying instruments. That is why it is called as derivatives. Derivatives name came from derived. It is being derived from some underlying instruments, and then the term derivatives came. Okay, so now within derivatives, as I mentioned, it's a broad term. There are multiple products within derivatives. To name few, we have futures, we have options, we have forwards, we have swaps. So there are multiple things that are there in derivatives. This particular session which are focusing today, we are focusing only on the options. So let me tell you what option is. Option is an contract which gives the buyer is nothing but the owner or the holder of the option, the right but not the obligation to buy or sell an underlying asset or instrument at a specified strike price on a specified date, depending on the form of the option. Now, to break up this particular definition or to give an explanation of this particular definition, see, option is one form of derivative product. Now, what does option tells? Option is basically one contract where the person who is buying this particular contract has the right but no obligation. Understand this word correctly. He has the right but not the obligation to buy or sell any particular underlying. What does this mean is, suppose you want to buy 100 shares of Reliance after 10 days, but you don't know what its price would be at after 10 days. You are anticipating that the price of Reliance after 10 days would be positive or would be more than what it is today. And there is some other person who thinks that the price of Reliance after 10 days would be low. So you both, the two persons, you and Mr. X, they both can get into a contract or they both can get into an options saying that after 10 days I will buy the Reliance and Mr. X will sell the Reliance. Okay. Now it won't be in a physical term, it won't be the physical delivery of shares, but it's just a contract saying that I will do so and Mr. X will do so and so. So this kind of contract which we define using options. Now there is a little difference in this in options is that the options comprises of few components. I will come to this in couple of minutes. But when you enter into a contract, you just pay some kind of premium. Now, what this premium is, I will tell you in few minutes. So let me just take you to the next step. See, the options, as I mentioned, it is basically contract where it gives the buyers the right, but not the obligation. So when I am the buyer and I say that, okay, I will buy 100 shares or 10 shares of Reliance, 100 shares of Reliance after 10 days, it means I have the right, but I don't have the obligation. So it is up to me whether after 10 days I will buy or not. So for this buying, I will pay Mr. X some amount. That amount is called as premium. So once I pay the premium to Mr. X, I have the right to buy 100 shares of Reliance after 10 days. But it is not an obligation for me. So it is up to me after 10 days. If I think the price of Reliance has gone up, I will buy it. Otherwise, I will not buy it. So what I'm trying to say is when you are buying the option, you have the right to exercise your option to buy or sell the underlying securities which you are seeing in that particular option. Okay, now why this options has been introduced into the market? Why this particular contract or this product of financial instrument has been introduced into the market, into the financial industry? So these here are three important reasons why options has been introduced or why options are being used into the market. The first important use is hedging. It is basically used by the big investors, foreign institutional investors, domestic institutional investors to hedge their positions, to hedge their portfolios. To give a live example, to give a very practical example, let's say you have a portfolio of 10 crore rupees in which you have 100 different shares, including Infosys, Reliance, Tata, Steel, Adani, etc. etc. Now, for some reason, let's say there is an election going on into the country, there are some financial crisis going on in the country, there is some war situation going on in the country, and you don't want to actually sell off your positions, but you want to protect yourself from the potential losses that could occur because of such uncertain external factors or uncertain situations. In that cases, you will go into the market, derivatives market, and you will buy the options. Since you are holding the positions, you will buy an option which will be used to hedge those particular positions. Okay, so this is one particular advantage of hedging your position so that you can minimize your losses or you can protect your losses, protect your capital in cases of uncertain situations. Second important usage of options are it is used for the arbitrage. Now there are many people who make benefit from the arbitrating strategies. There are many people who knows how to use options for different arbitraging purposes. They apply different strategies. They analyze the market, they look after the price movement, they identify the volatility, and then they design the strategy for arbitraging. So this is another usage of options where people define their strategies to make the money. Third usage is making money, which is pure gambling, or where you don't use any strategies, you don't have any financial what do you say, the hedging perspective, but you are just buying the naked puts or naked calls or the naked options to make money. You are just anticipating some kind of movement into the market, and you are using options as one of the money generating tools. So these are the three important usages of options that generally people do. Okay, now let's see what different types of options we have. We came to know that there are options which are used to hedge our positions, to arbitrage, and to make the money. Now, what kind of options, what are the types of options that are available in the market? Or what are the different types of options which are part of this particular product? So there are two main types of options called as call and put. As I mentioned before, when we say option, we have the right but not the obligation. So when I say call option, call is an option, or it is basically an agreement that gives the investor the right but not the obligation to buy a stock or a bond or a commodity or any other instrument at a specified price within a specified time period. Your profit on the call will depend if the underlying asset increases in the price. Now let me explain you in a very simple language, or let me try to break this statement. See, let's say you are anticipating that the market will rise. Let's say you are seeing that the price of Reliance is going to go up in the another 10 days. So what you can do is you will enter into an agreement with some person called as Mr. X, who thinks that the price of Reliance is going to go down after 10 days. So you are saying to Mr. X that I will buy the contract, I will buy the Reliance at so and so price after 10 days. So you are just giving your statement to Mr. X. But Mr. X does not know you. So Mr. X asks you, how should I trust you? Why should I trust you that you are going to buy 100 shares from me after 10 days? In this case, Mr. In this case, what I am going to do is to give Mr. X the confidence that I am going to buy 100 shares of Reliance after 10 days. I will pay some premium or some token amount to Mr. X. This token amount is called as the price of the call. Since I am bullish, since I am expecting the price of Reliance to go up, I will enter into an agreement of the call and I will buy the call. Okay, so this is called as the call option, where you are bullish about something and you are buying the call option of it. And to get the other party into the confidence, you pay some premium or some token amount to that particular person. Now, in our Indian Stock Exchange, in the NSE, the calls are called as CE. For example, if we take an example of Nifty, it is called as Nifty 8800 CE. Now, what this 80 and 8800 is, I will come to this after few minutes. For now, you can assume that there is something called as call for the Nifty and it is represented as Nifty 8800 CE. The other type of options is called as put. Now, let me read this definition for you. A put option is an option contract giving the owner the right but not the obligation to sell a specified amount of an underlying security at a specified price within a specified time. This is opposite of a call option, which gives the holder the right to buy shares. Okay, if you have understand the call, you can understand the put as well. Put is exactly opposite of call. So let me give you again an example for what put is. Let's say you have 5,000 shares of Reliance with you. You think after 10 days, the price of Reliance shares is going to go down. So what you will do is you will find some person in the market called as Mr. X, who thinks that the price of Reliance is going to go up. So you will contact Mr. X and you will get into an agreement saying him that after 10 days I will give you 100 shares of Reliance at XYZ price. So the price at which you want to sell the shares of Reliance to Mr. X is defined today itself. And Mr. X agrees to it. So now, but you're not selling it today. So you both have to get into a mutual agreement. Because when you say today, when today you say that I will sell 100 shares of Reliance after 10 days, Mr. X needs something as a confirmation. And you as well also needs a confirmation. You also need a proof. You also need an agreement so that Mr. X does not revert after 10 days. So what we do is we enter into a contract. We enter into an option called as put, because now you are bearish. You are saying that the price of Reliance is going to go down. So you will buy puts. You will buy put in an assumption that after 10 days the price of Reliance is going to go down. Now after 10 days you will actually exercise this position. You will actually exercise this particular contract as per the definition. Now, since you have bought the puts, you are again have the rights but not the obligation. So after 10 days, if you think the price of Reliance has actually went down, you can sell the shares of Reliance to Mr. X at whatever price you have agreed before. So you are ultimately into profit. Now, how you are ultimately into profit, I will explain you after a few minutes with a practical example. Okay, so this is what the put options are. They are basically meant when you are bearish about anything. Let's take a step ahead. Let's understand what are the option styles available in the financial industry. See, there are three different types of styles of the options available. The first one is called as European style of options. Second is called as American, and third is called as Bermudan. Now, what is the difference between each of them? See, this is all for the theoretical knowledge. But if you don't understand this, maybe you will trade into the market without having the proper knowledge of options. So definitely you won't need all this thing while you're actually trading, but you should know this to understand how the options are designed, what are the purpose of the options, and what is the logic why the options was introduced into the market. Okay, so let's come to the first style. European style of options is the first style of options. In this particular option, what it says is it is a kind of an option that may only be exercised on the expiration. When you buy an option, when you enter into an option contract with anyone, you have to define a date. This particular date is called as an expiry date. Okay, so when we are entering into an European option, the European option says that you can only exercise it at the date of expiry. Now, what does the word exercise mean? The word exercise it does not mean the physical exercise. The word exercise means when you say to Mr. X that after 10 days I will sell 100 shares of Reliance, it means after 10 days you will sell it physically to Mr. X. So this is called as exercising. Whatever you have told, you are doing it. That is called as exercising. Second contract is American contract, American style of options. In this particular option, you can exercise at any given on any given trading day up up till the expiry date. So let's say today here you have told Mr. X that I will sell you 100 shares of Reliance after 10 days. But if you have entered into an American option contract with Mr. X, you can sell that 100 shares of Reliance on any day starting from today till the next 10 days. So that is called as American option strategy. In case of European, you can only sell those 100 shares to Mr. X after 10 days only. That is on the predefined date which you have fixed. Okay, so this is the difference between American and European. The third one is the Bermudan. So what it says is you can exercise an option on specified dates or on before expiration. Now, let me explain you in a simple language. Let's say today you have told Mr. X, you have entered into a contract with Mr. X that you will sell 100 shares of Reliance after 10 days. But at the same time, you have also agreed that there will be 2 more days starting from today till the 10 days when I am eligible to sell 100 shares of Reliance. So not only on the day of expiry, not on the only last day, but you also define few other days where you can exercise this. So it is basically a combination of European and the American, where you can, like European, you can exercise it at the end on the expiry days, as well as you can define few days between today and the expiry days, when at that point and on those days also you can do the exercise. So unlike American, you cannot exercise or you cannot sell the shares to Mr. X on any odd day, but you can sell the shares of Reliance to Mr. X only on the agreed dates until the expiry. So let's say today is 1st of January. You have told Mr. X that on 10th of till 10th of January, I will sell you 100 shares of Reliance. And you have also defined that I will sell you the shares only on 5th of January and 7th of January, or on the last day 10th of January. So you have defined the dates. This is called as Bermudan style of options. Okay. Anyways, this is not used in our Indian stock exchange. This was just for your theoretical knowledge so that you know what kind of option styles are. We only use in the Indian stock market, we only use the European style of options, where the exercising is only possible on the last day of options. Sorry, last day of expiry. Okay, now coming to further details of the options, let's look at what are the components of the options. Okay, the first component is called as the strike price. Now what does strike price means? Strike price is the price at which a specific derivative contract can be exercised. The term is mostly used to describe the options in which prices are fixed in contract. So again, let's come to an example of ourselves and Mr. X. I have told to Mr. X that I will sell you 100 shares of Reliance after 10 days, that is on 10th of January. And I will sell you the shares at 1000 rupees. Whatever is the price today, irrespective of the price today or irrespective of the price after 10 days, I will sell Mr. X 100 shares of Reliance at 1000 rupees. So this price 1000, this is called as the strike price. The price that you have agreed with Mr. X is called as the strike price. We will look into what the practical example also in couple of minutes. The next component is called as the options premium. It is the total cost to buy an option which gives the holder the right but not the obligation to buy or sell the underlying financial instrument at a specified strike price. Let me break this up for you. When I say I want to buy an option or I want to get into a contract with Mr. X for selling 100 shares of Reliance at 1000 rupees after 10 days, I need to get into an agreement with Mr. X. And as I told you before, to get into the confidence, to get into the agreement, you pay some kind of token, some kind of assurance money, or some kind of premium to Mr. X. So this amount which you are paying to Mr. X to getting him into confidence, to getting into an agreement, is called as options premium. Now, just because you have paid this particular premium, you have the right to sell it or not to sell it, or to buy it or not to buy it after 10 days. When I come to a practical example, all these terms will get much more clearer to you if you're very new to the options. If you're already familiar with the options, you might already be understanding what I'm trying to say. But if you're very new to the options, you will understand all these terms when I come to a practical example in NSE. Okay, so so this is options premium is something which you pay to enter into a contract. Now, the options premium comprises of two prices, two values. One is called as the intrinsic value and the other is called as a time value. Intrinsic value is the value primarily used in options pricing to indicate the amount of an option is in the money. Well, I can only explain you with this example. Time value, the portion of an amount options premium that is attributable to the amount of the time remaining until the expiration of the option contract is called as a time value. So again, I can explain you much better only with a couple of examples. So I will explain you in a couple of minutes. Time decay is another component in options that you should take care. What does time decay says? Time decay is a ratio of the change in an option's price to the decrease the time to expiration. So it is basically a ratio of how the prices of the option is moving to the number of days that are left to the expiry, or the number of days left to do your settlement. Okay, so this is what is called as time decay. The price of the options keeps changing as and when time progresses towards the expiry. Now, whatever I explained you in this particular slide, strike price, option price, intrinsic value, time value, and the time decay, let me explain you with a live example or with an help of an example with few numbers so that you understand what these things mean. Okay, so here we are taking an example of Nifty's options. So to understand this example, we have set few parameters. Let's say Nifty is currently trading at 8700. It means the Nifty index or the Nifty spot is currently at 8700. We are going to deal into the options whose strike price is 8800. Now, as I mentioned before, there are two types of options. One is called as call and one is called as put. The call is represented by CE, as you can see where my mouse is highlighted, and the put is represented by PE. So we will take into an example of Nifty October 8800 CE, Nifty October 8800 P. Now let's understand this contract definition. Nifty means the index that we are currently trading, on which we are buying or selling the options. October is basically the month when this contract will get expire or when these options will get expire. 8800 is the strike price. CE is called as call. Similarly, here P is called as put. So let's take the first example, Nifty October 8800C. I go into the market, I look at the price of 8800C, the price is 109 rupees. Now how to interpret this particular price of 109 rupees? See, now understand, we are entering into a call. Call is CE. Call means we are bullish. Okay, so when I'm saying 8800 call price is 109 rupees, I have to check what is my current value of Nifty. The current value of Nifty is 8700. What I'm saying is I will buy Nifty at 8800. When I say Nifty October 8800 CE, it means I will buy 8800 Nifty at 8800. Now understand, today Nifty is what? 8700. And you are saying today itself that I am going to buy Nifty at 8800. It means you are paying 100 rupees more. Correct? The 8800 is not yet reached. 8800 is still 100 points away. But you think that over a period of time, in the 1 month's time until expiry, there could be a huge progress in the Nifty. So what you're saying is I want to buy Nifty at 8800. So since the price is 8700 and you are very optimistic, the price has not yet reached 8800, but still you want to buy, and you see the price is 109. So in this case, the intrinsic value is 0. The intrinsic value means the actual benefit that you are getting currently. What is the inherent benefit or inherent value of this option or inherent profit that you see while entering into the contract? If I compare today the Nifty spot is 8700 and I am saying that I am going to buy Nifty at 8800, or I see Nifty as 8800, Nifty will go to 8800. So it means the currently what I'm saying is far away. So in that case, the actual profit that I have comparing the price of today Nifty spot, the actual profit is zero, because I told that I'm going to that the Nifty is going at 8800, but actually the Nifty is at 8700. So there is no profit you are having. There is no intrinsic, there is no internal profit in this contract. So the intrinsic value is zero. Now the other value is called as time value. So what is this? Since you are not in the benefit, then why is the price 109? See, as I mentioned you, I gave you an example of X, Mr. X. You are entering into a contract with Mr. X. So so you are saying that I will do something after X amount of days. In this case, I will do this at the end of the October. So on the other side, to take that other person into confidence, you have to pay some amount to him, because you have a time of 30 days until expiry. So this time which you have 30 days, you are paying this price for the 30 days. So the price which is there 109 is basically called as a time value. It is not at all an intrinsic value. Now let's come to another example. Now let's come to an put part of it. So here is an example of Nifty October 8800 P or put. Put or P means you are bearish. You are saying that the Nifty is going to go down. So now with 8800 P, what you're trying to say is I am selling Nifty at 8800, or Nifty will go below 8800. Now let's see what is the price currently on the Nifty today. It is 8700, and what you are saying, I want to sell Nifty at 8800. So you are trying to sell something at a higher price than current price. So let's say if you are successful in selling it at 8800, it means what? You are directly getting a benefit of 100 rupees today itself. So the benefit that you get immediately today itself is called as the intrinsic value. So see here, the price of this particular put is, let's say, 226. So now let's calculate the intrinsic value. So here you are selling at 8800 and the current price is 8700. So your direct benefit is 100 rupees or 100 points. So your intrinsic value is 100. Now the total price is always a combination or sum of intrinsic value and the time value. So intrinsic value, since intrinsic value is 100, the time value is total price minus the intrinsic value, which is 126. So this 126 rupees that you are paying today extra is the price that you are paying for the time that is remaining to exercise this contract, because you are expecting the price of the Nifty to go further below. And for the same reason, you are paying this options, this premium to Mr. X. Okay, so this is how you basically calculate the time value and the intrinsic value of the options, or you understand basically. Now, types of the options contract. What are the different types of option contracts that are available in the market? See, there are three different types of option contracts. One is called as at the money, second is called in the money, third is called out of the money. Now, at the money means when when the strike price is similar or identical or close to the actual price of that particular underlying, then it is called as the at the money contract. For example, if Nifty is trading at 8700 and you are buying the call and put of 8700, it is called as at the money call, at the money put, or at the money options. Second is in the money. In the money means when you are already entering into an option which is already running into profit. The very live or the case perfect example of this is the second put option that we took. The current price of Nifty spot was 8700 and we sold. We are saying that the Nifty is going to go below 8800, or I'm trying to sell Nifty at 8800. So it means you're already in a profit of 100 points, 100 rupees today itself. So when you enter in such type of contracts, it is called as in the money contracts. Now this applies for both call and put. In case of call, when you buy the options with a strike price which is less than the current price, it is called as in the money. When you're selling something, when you're buying the puts and the strike price of the put is higher than the current price, then you are in the money put. The third type of options is called as out of the money. The very perfect example of this is the call that we took, the first example that we took. The Nifty is currently as 8700 and we are saying that I'm buying Nifty at 8800. So you're optimistic about that something, but if you look at the current situation, you are into a loss, or you are basically optimistic about something. So in that cases, see here the current price of the Nifty spot is 8700 and you're saying that I'm going to buy Nifty at 8800, or I look the Nifty at 8800. So you are seeing the target which is something far from the current price. So such type of contracts are called as out of the money contracts. Okay. So these are the three basic types: at the money, in the money, and out of the money. I will show you with an example from the NSE what these three terms mean. Now, what are the risk in options? Let's understand the risk in options. See, options has a limited risk and unlimited profit. What does this mean is the total amount of limited risk is the amount of premium or the amount of option price that you pay is your total risk. Okay. So when you're buying the options, what you're doing is you're just paying the premium, you're just paying the token. That is the your maximum risk that is associated. And the benefit is like unlimited. If the price of the option goes well above, if you're the whatever price you have anticipated, if the price of that particular underlying goes beyond your anticipated price, that amount of profit that you can make is unlimited. Okay, that is why it is always told that in the options the risk is limited but the profit is unlimited. Now in spite of this, we know that when we buy the options we are just paying a minimum amount, but we are paying this minimum amount to someone else. So when you are buying the options, you are at a minimum risk and on a maximum profit side, but at the same time, if you are at the minimum risk and the maximum profit, someone else on the other side is on the reverse side, that is he is on the limited profit side and an unlimited loss side. In spite of knowing all this, why does the people write or sell the options? This is the common question that people have, or the newcomers have, that when you have limited risk and unlimited profit in buying, why do the people sell the options? See, selling, the people who do the selling of options or the writing. So to clear one more thing here, writing of options is also called as selling of options. Okay, so the people who do writing or the selling of options, they have the benefit, or they do this to earn the premium. So that is their main motive behind writing the options. So if the expiry, till the expiry, see there is a limited period of time this contract is valid and you are anticipating some price. So within this period of time, if that particular anticipation of the price does not happen, then the person to whom you have paid the premium or the token remains with him. So the basic profit or the basic interest of that particular person is the premium that you pay. Okay, so that is the main reason why the people sell or write the options. They just want to get the benefit of the premium that they receive while selling the options. Now, whatever I told through the theoretical terms, let me show you through a pictorial way. How do we go about? See, here I'm trying to explain you call option buying. When we do the call option buying, let's say you are an investor, you expect some particular stock price to go up. So what you will do is you will either go and buy that particular stock. That is one way, or the traditional way which you might be doing up till now. The other way is you go into the market, you buy a call option on the particular stock. So in this case, when you're buying the call option, what you're doing is you are paying Mr. X only a limited amount. Now let's understand why people go for the options instead of equities, or instead of the physical stock. Let's say the price of Reliance is 1000 rupees and you want to buy 100 shares of Reliance. What is the total cost? 100 into 1000 is 1 lakh rupees. So you need 1 lakh rupees to buy physical shares of Reliance, 100 physical shares. But at the same time, there is another option available where you say Mr. X that, okay, Mr. X, I will buy Reliance after 10 days at 1000 rupees, at 1010 rupees. And Mr. X says, okay, fine, I will give you 100 shares of Reliance after 10 days at 110 rupees, at 1010 rupees. So today, to get into this particular contract, Mr. X needs some confidence and you as well needs the confidence. So what you're doing is you are saying, Mr. X, that I will do this after 10 days, but for the 10 days you keep this amount with you. So you're just paying a token. It is similar to like when you're going to book a flat, or when you go for buying a flat, you don't pay the entire amount at the upfront. You just go to the builder, you pay a nominal amount which is called as a token amount, and then you book the flat. Why you do this? Because you anticipate that after 1 year or after 2 years or after 3 months, the price of the property might go up. So you buy today itself and you say to the builder that I will buy this flat or this property after 3 months in 10 lakh rupees. But today I am giving you only 20,000 rupees. Okay, so now now this is very much related to the options. This is the same way how options work. So let's say after 3 months you see that the price of the flat which which you told to the builder that I'm going to buy at 10 lakh rupees has now become 5 lakh rupees. Let's say there has been some crisis in the realty market and the property of your flat that you are about to buy reduces from 10 lakh to 5 lakh rupees. So now what you have done, you have just paid 20,000 rupees. Now if after 3 months, if you go and pay him the 10 lakh rupees, do you think it will make sense to you? Because the price at that point of time is 5 lakh rupees. So what you can do is you can go to some other builder and buy the same flat or similar flat at 5 lakh rupees. So you have just paid a token of 20,000 rupees. So what is your loss to the old builder, the first builder? The amount which you paid as a token, the 20,000 rupees you paid as a token, that is your only loss, right? But since the price has now come to from 10 lakhs to 5 lakhs rupees, you go to some other builder and you say, okay, I'm now buying from this other builder. So in 3 months time, though you have anticipated that the price of the flat might go up, but it has actually gone down. So now the definition of the options come into picture. Since you have buying the option, you have the right but not the obligation. So here in the case of that builder and the you and the builder, you have paid the token amount, so you have the right to buy the flat or not to buy the flat. Okay, so similar goes with the options. When you buy a call, any buy when you buy any option, you have the right, but you are not obliged not to do it. Okay, so similar is the case with the call. When you are bullish, you can buy the call options. Similarly is the put option buying. Investor, as an investor, let's say you expect the price of the stock to go down, There are two ways. You can either sell the stocks or you can buy the puts. Now let's come to the basic option strategies. See, these are the basic option strategies which are called as long call, which means you are buying the call. Short call, you are selling the call. Long put, it means you are buying the put. Short put means you are selling the put. Okay. Now let's take a tabular format of this and how the profit and loss are related in this kind of strategies. So when you're saying that when you're into a strategy called as long call, you are basically buying the call, and you will buy the call when you are bullish or your market view is uptrend. Okay. So when you're buying the call, you have a chances of unlimited profit because the price of the call can go to any extent. But at the same time, you have a limited loss. Limited loss is nothing but the amount of the premium that you paid to buy this call is your maximum loss. So whatever amount you are paying upfront to buy a particular option is your maximum loss. Now short call. See, if you are buying the call, there is someone who is selling it. So when someone is selling it, it is called as short call. Now when do you short? When you are buying it, it means you are bullish, and when you are selling the call, it means you are bearish. Okay. So you are selling the call when you have a market view of downtrend or when your sentiments are bearish. Now in this case, when you're selling the call, you get some premium amount. So the amount which you have got upfront as a premium is the maximum profit that you can get by selling it. But at the same time, if the call prices go up or if the market turns into a huge bullishness, then the price of the call can go to any amount, and in that case, since you have sold the options at a low price, you have to cover it at a higher price. So in such cases, the chances of loss is unlimited. That is why it is always told that when you sell the options, your profit is limited but your loss is unlimited. Now similarly applies for the put. When you buy the put, it means you are bearish or in the downtrend. Sorry, let me correct this. Sorry. So yeah, there was some typo mistake, so I've corrected it. So when you are basically buying a put, when you are long put, it means you are buying a put. It means your sentiments are bearish and your market view is downtrend. So again, when you are buying it, there is a limited loss and unlimited profit. Same is the case when you're shorting the put. It means you are selling the put. It means you are bullish and your market view is that the trend would be upside. So in this case, when you're shorting it, whatever premium you get is your limited profit, but the chances of the loss are unlimited if your analysis go wrong, if your market views go wrong. Okay, now let's take a practical example. So all those theories which I told you till now, we will look into the practical way of, or we will try to relate practically all those terms which I've explained you in last 30 or 40 minutes. I will take you to the NS India website and explain you what exactly how they are related. See, okay, let's me take new a new URL. Let me take you to the website of NSE India. So this is the official website of National Stock Exchange. Here, now we need to identify the derivatives. We need to go and look for the derivatives or the options. See, options are one product of derivatives. So we have to look into the derivatives part to see what the options are and how to study the options and how to uh, analyze the options. So what we'll do is we'll come to this live market section. If you see here where my mouse is highlighting currently, in the option chains, you can see this option chain. So within options, you will find equity derivatives. See, there are multiple derivatives, equity derivatives, currency derivatives. As I mentioned, these are options. These are basically derivatives, and derivatives are based on multiple underlyings. They could be currencies, they could be commodities, they could be equities, they could be bonds. It could be anything. So we are interested as of now in the equity derivatives. I will show you an example of Nifty. See, when you come to the equity derivatives, by default, the values are shown for the Nifty contract. Okay, so here as you can see, the option contracts is for Nifty by default. You can select all these different indexes and you can get the options values for this particular contract. Now, as I mentioned, there are two types of options, call and put. See here, this is calls and here this is put. So this left hand side are the call options and the right hand side are the put options. Now let me show you how to study this, how to study this table. See, also look at here. See, the underlying index value is 8611 as on 30th September. Okay, so it means that the Nifty index currently is 8600. And as you can see, I told you the strike price. See, the strike price is here. And I told you the premium is mentioned under LTP. Okay, so now here on the strike price, you can see different things. What is our current Nifty index? 8600. So I will show you what, uh, sorry, I will show you how to identify the options that are close to this price. Since it is current price is 8600, see you will see two bifurcation. When it is 8600, you will see a line difference in the colors. One which are above 8600 and one which are below 8600. You can see a clear differentiation here. Now since 8600 is the current index value, these are the different strike prices: 8650, 8550, 8600, 87, 8750. So these are the different strike prices. It means it just suggests that we are looking into the future prospect of Nifty index at this different levels. So now let's say consider we will take two examples. We will consider a case of bullish view. We will consider a case of bearish view. Now the Nifty index is currently at 8600, and let's say my analysis, my study, my chart expert or my chart analysis, everything, my formula says that Nifty is going to go till 8900, that is 300 points above, in 1 month's time. Okay, so what I will do is, currently Nifty is at 8600. I am looking at Nifty at 8900. Okay, so my current strike price is 8600. This is the call. So what I will do is I will look at the call, because I am bullish. I want to buy the call. So what is the price here? 8175 for the 8600 call. Okay, now what I'm anticipating? I'm anticipating 8900 the Nifty. So let's say after 1 month, when this contract is going to get expire, the price of Nifty touches 8900. So today, if you are buying the call of 8600 at 175 rupees, after 1 month, when the price is 8900, what will be your profit? Let's say you have bought at 8600 and the current market price on the day of expiry is 8900. What is your profit? Your profit is 300 points. You are 300 points plus from your buy levels. But now understand this. Your direct profit is not 300 rupees, because you bought the call for 8600, but to buy this call of 8600 you paid a price of 175 rupees. So your total investment is 175 rupees. But after 1 month, since your prediction was right and the Nifty went till 800 8900 per index value, your profit is 300. Total profit is 300, but out of 300, 175 is your total investment. So the actual profit that you made is 125 rupees on per option contract. So this is how your profit it gets evaluated. Now let's say you bought at 8600. Let me explain you with the help of some notepad example. Let's say Nifty currently is 8600. You buy call at 175 rupees. 1 month Nifty is 8900. Total profit is 300. Your cost is 175. Net profit is 300 minus 175 is equal to 125. Now let's say Nifty does not go to 8900. Nifty goes only till 8800 after 1 month. Okay. So case 2, Nifty reaches 8800 after 1 month. So your total profit is 8800 minus 8600 because you bought a call of 8600. So your total profit is 200 points. Your cost is 175. So your net profit is 200 minus 175 equal to 25. This is your net profit. Now consider another case, case 3. Nifty after 1 month is 8700. What is your total profit? What you told? You bought at 8600 call and now it is currently 8700. So your total profit is 100 points. What is your cost involved? Cost involved is 175. What is your net profit? Net profit will be 175 minus 100. Sorry, your selling price currently is your net total profit today is 100, but your cost is 175. So your net profit is minus 75. That is, you are in a loss of 75. Okay, so now here this is something which you need to understand before you are buying any call or put. You need to understand the break even point. See, you bought 8600 call at 175 rupees. But after 1 month, Nifty went from 8600 to 8700 only. So your estimation was correct, but your estimation was not very correct. So you could only make a profit of 100 points. But now, no doubt that you made a profit of 100 points. But to get this profit of 100 points, your total investment was 175. So first you paid 175 rupees to make a profit. You made a profit, but you could only made a profit of 100 rupees. So your investment was more, but your return was less. So ultimately you ended up into loss. So now we will see how to identify the break-even point. How to identify the break-even point. So now current price is 8600. Your cost is 175. So what is your profit point? When will you start making the profit? Since you have bought the call at 175 rupees, strike price is 8600. So you can make the profit only when you are getting the total profit more than 175. So it means when the Nifty goes above 8600 plus 175 that you was your cost, then you will start making the profit. So your break even point is 8775. So if Nifty closes above or on the last day of expiry, if the Nifty is above 8775, then only your 175 rupees investment is going to give you a profit. So at the time of buying this call, whatever analysis you made, based on this analysis, you have to check whether Nifty is going to go above 8775. If your analysis says that yes, Nifty can go above 8775, then in that case, you should go ahead and invest at 175 rupees. Otherwise, you should not enter into this particular contract. You should not buy the call. Now, similarly is the case when you sell it. Let's say now this was an example of buying. Now, let's say you are bearish. You think that the price, that the Nifty index is not going to go beyond 8600. Current price is 8600. Current Nifty index is 8600. Your expectation is Nifty will not go beyond 8600. Matlab, means the Nifty is not going to go above 8600. So in that case, what you can do, how you can make the benefit, you can find someone who is interested or who is bullish about Nifty, and you can ask him to pay you the premium. So what you will ask him, you will tell him that buy 8600 call from me, I will give you 8600 call in 175 rupees. Because as per your analysis, whatever premium you get, it's your profit. And you don't see Nifty going above 8600. So in this case, the premium that you receive 175 rupees is the your total profit, is your full profit. So if the Nifty goes or ends below 8600, whatever premium you received is your full profit. But let's say if Nifty goes little above 8600, then your profit will not be equivalent to what was the initial premium amount that you took. Now let me show you with an help of example. Let's say Nifty current market price is 8600. You sell Nifty 8600 CE at 175. So your profit is total profit is 175, because 175, because you have sold something, you got the payment, you got 175 rupees ka payment, so your total profit is 175. But on the last day, Nifty is 87, let's say 8650. Nifty rised by 50 points. So since you sold a Nifty at 8600 and now it is 8650, so basically your loss is 8600 is something you bought, sorry, you sold, and then 8650 is you will buy it back. So your total loss is minus 50. Your loss in this particular is minus 50, but your total profit was 175 rupees, because to sell this 8600 call you took 175 rupees, and now on the last day you are paying back 50 rupees, because you sold at 8600 and now the price is 8650. So this is basically your net loss in this particular transaction. But then the total or your profit net profit or loss is equal to 175 was your initial profit, then you got a loss of 50 rupees, so your net result is 125 profit. So again here we will have to identify the break even point. What is our break even point when we are selling it? So the break even point will be, since we are selling it at 86 88 8600 call, we are selling at 800 and 175. So see, when we are selling Nifty call 8600 at 175, it means we got 175 rupees in our pocket. So what is my net cost, what is my net value of buying Nifty is 8525, sorry, 8425. Sorry, hold on. Yeah, so you get the in this case we'll do a addition. So we get a total of 8775. So this is basically a break even point. Why we have done a plus here? Because you are trying to sell 8600 call and you have got a payment of 175 rupees. So your total cost will be 8775, because though you have sold at 8600 but you got 175 rupees, another 175 rupees for selling this. So your total selling price becomes 8775. Now if the price, if the nifty goes above 8775, then your loss will start. If the price does not stays below 8775, you will always remain in the profit. Okay, so this is how you need to calculate your break even point before you buy or sell any particular options. So similarly here, you can see different, there are different ways. See, the more far you go away, see now currently the 8600 and call. So as I mentioned before, that there are three types of options: at the money option, in the money option, and out of the money option. So since currently the index is trading at, the current Nifty index is 8600. So 8600 call and put, they are called as at the money options. In case of call, in case of call, the higher values they will be called as out of the money call, because those values are not yet reached and you are expecting it to reach. You are optimistic about those values. So all these higher values, they all are called as out of the money contracts for Nifty. Similarly, all the lower values of Nifty, it has already been reached and currently Nifty is already above those levels and you are bullish. So you have already in profit, the Nifty is already in plus with those lower levels. So these levels, if you buy the options of this particular levels which are below 8600, they are called as in the money call. Okay, so whatever is in the money call, whatever is the in the money for call becomes out of the money for put, and whatever is out of money for the call becomes in the money for the put. See, call and put are both reciprocal, they both are opposite to each other. So whatever is at the whatever is in the money in the call, they will become out of the money in the puts. So see, in the put, all the values which are above 8600, they are called as out of the money put. Sorry, in the money put. All these values which are higher than the 8600, they are all called as at in the money puts, because they are already running into profit. And all the Nifty contracts which are below the current price of Nifty, they all are, those all levels are about to come. So we are optimistic on all those levels that the Nifty will fall and those targets would be, those levels would be achieved. So in this case, all the values, all the strike prices which are below 8600, they are out of the money options, out of the money put. Okay, so this is how you can identify what are at the money, in the money, and out of the money. So whatever is close to the index 8600, so 8600 call and put, they both are at the money, and the option contracts which are above and below, they are either in the money or out of the money. So that is how you identify. There are multiple other things. There is open interest, there is change in open interest, there is volume. So there are multiple things which are there in the options. So maybe this is a separate topic, more advanced topic on the open interest and volumes, which I will try to cover in some other session of the options. In this particular session, uh, uh, this is all what I wanted to show. But this was the index one. So let's see, if I want to, I will show you an example of some stock options also. So let's say if you want to search any particular stock options, you can come here and you can type the name. Let's say I want to search for the Reliance options. I type in the name of the Reliance, I do a go. I wait for some time and then I will get all the options for the Reliance. See, see now here you will see the Reliance cash market price is 1084.5. Okay, so these are all its options. We will identify what is the correct strike price, 8084. So whichever option strike price which are close to 1084, they will be called as at the money. See, can you look at can you look the difference in the colors here on this particular line, 1080 to 1090? Because 1084 falls between 1080 and 1090. So that is why you will see a change in the color here at this particular level. All the above are little yellowish, all the below are white. Similarly here all the above are white and all the below are yellowish. So similar rule applies here. The option premium is the LTP part. This is called as the option premium, the values which you see in the LTP. So since the current Reliance price is 1084, all the values which are less than it, all the values which are less than 1084, they are in the money call and out of the money puts. Similarly, all the price that are higher than the current price, they are out of the money call and in the money put. If you click here, you will be taken to a new page where specific details about only this particular contract is mentioned. You can see the underlying value here. You can see the average price. You can see what is the total volume which is traded. You can see the LTP here. So this is how you can analyze the price of the options. And accordingly, you can take your trading decisions. Accordingly, you can do your hedgings and everything. I'm pretty sure those who are watching this video, none of you would be from the hedging background or the intention of hedging. Most everyone would be of the arbitraging. Everyone wanted to use options for the arbitraging or for the money making purpose. So this was the some basic knowledge about options that I was having and that I could share with you. Okay, so this was all what I was having for the options perspective. But before I finish my this session, I would also like to highlight few things. There are a couple of website. There are few maniacs, few people who are just unethical, who are shamelessly copying the contents or have already copied the contents from my website without giving due credit to my work, and they have just unethically shamelessly copied the contents from my website. I have taken a screenshot of one of this maniac website which have copied the contents and which have put all these calculators, this all these calculators have been copied from my website. Those who understand JavaScript, he has copied all the JavaScript code from my website, silently came to my website and copied all those JavaScript code and has entered put on his particular website. So try and avoid such people, those who don't have ethics, don't the people those who have no moral ethics uh, in this online world. You can I don't need to say what kind of people they would be. So just try and avoid such people because they don't have anything in genuinity. They are just leechers who copy the contents from some other websites. So I'm just mentioning about one of section of the website which I can see the free tools which has been put on this particular website. All these contents have been copied from my website. I'm not sure about the other contents, but all these contents, all this code has been copied from my website. Okay, so this was all about the trading related. But apart from this, there are few things also which I think we should take care of. One important message that I want to give through this particular video is please try and stop the food wastage. There are many people who either cannot afford to eat or who don't even get to eat. So if we are so lucky that we are getting the food to eat, we should respect it. We should try and avoid as much wastage of that particular food. uh, I mean, we should avoid the wastage so that it can be used for someone else. So it's a request, try and avoid as much food wastage as you can. Other important thing which I want to share is please try and stop killing animals, eating non-vegetarians, or try to see there are many good things available for your pleasure. There are many good things available to feed your stomach. So it's just a request from my side. Love the animals, share few things with animals. They too deserve the love, they too deserve the respect to live with equal dignity in this world. Try to make sure that you don't hurt the animals. Let them live on their own way. The divine has brought them to earth for some purpose. So please try and respect uh, their individuality, their life. If you cannot love, at least if you can't love them, at least don't kill them. So these are a few things which I wanted to share apart from the trading related world. Try and share, spend some love with animals too. Another important thing, as I mentioned in the beginning, I am associated with Zerodha as one of their business partners. So I help the people open their trading account with Zerodha, and the people who approach me for Zerodha account opening or who open the account in Zerodha through my website, they get the benefit of all the paid products of my website. They get benefits on all my paid products, on all my paid services. Now, what are the benefits? The benefits you get is you get the free or discounted access to the paid products of pivottrading.net. As of now, as of today, all the products on my website which are paid, they are all available for free to all my Zerodha customers. In future, if there are any more products, they could be either available at they would either be available at discounted price or for free. But as of today, all the products are free. Second advantage you get is I add you to my WhatsApp group where I share my analysis, calls, my guidance, or whatever knowledge I have. I try to share it on WhatsApp. So you get benefit of my WhatsApp group as well. Other benefit you get is you get discount on my any future trainings or seminars. The fourth benefit you get is there are my in future if I have any paid videos or on my existing paid videos, there are special discounts, more than 50 to 60% of the discount for the people who are associated with me through Zerodha. So in case you are planning to open an account in Zerodha, do approach me and I can help you. Plus you will get all these benefits. The main benefit is you get all my paid products for free. The paid products are ranging from 500 rupees to 2000 to 3000 rupees per month, which you get completely for free as of today. So that is all what I wanted to share with you. Um, so these are my contact details. You can either mail me here on this particular email address, or you can text or WhatsApp me on this particular number. Thank you so much for your patience. I hope that your knowledge on options would have definitely increased, or at least I would have helped you in understanding options to at least to some extent or to a significant extent, so that you can go more in this particular direction and achieve your success in the options in field as well. Thank you so much. Thanks for your patience. Thanks for watching till the end. Bye bye. Take care.